Shall we start the class? I hope you all are safe. We are in a sort of in a peak of a crisis. So the safety is most important. So even though it's an optimistic assumption, I hope you all are safe and you all are continue your studies. Am I visible? Am I audible?
Yes, sir.
Can someone give a feedback?
Yes, sir.
Okay, thank you so much. So today's class is the third class of the risk management. The last two classes we have studied about risk management. The first class we have discussed about some foundation about the risk management, and then we move to the some different sections like risk management framework. We discussed, and under that risk management framework we have discussed about silo based risk management framework as well as integrated risk management framework. Under the integrated risk management framework we have discussed about their different process and all. So I explained to you all the diagram and all. Then we have discussed about 3 lines of defense, under which first line of defense, we have discussed about the first line of defense, second line of defense, and third line of defense. And internal audit become the third line of defense, and it is most independent, comparably most independent than other two line of defense, first line and second line. And in the second line of defense, we had studied about the centralized risk management department and compliance department will coming under the second line of defense. And the business unit will become the, or branches of business units become the first line of defense. They are responsible for internal control or own the risk. They are the people going to own the risk. And then we have discussed about these financial risk. We have detailedly discussed about the financial risk, under which we have discussed about credit risk and then concentration risk, default risk. And on top of that, in addition to that, we have discussed something about related party transactions and preferential treatments, and how can we identify a preferential treatment and all, and circumstances to the preferential treatments also we have studied. Then we have studied about the liquidity risk and ALCO. Then finally we have discussed about the different type of market risk. So currency risk, interest rate risk, price risk, and commodity price risk and all, we have discussed about it. So actually today is the sort of latter part of this risk management section. Today we will discuss, first half of the class we will discuss about some more theoretical part, and then in the second half we will discuss about past papers. So that is the structure of today's class. If you all have any questions, you all can answer related to the last two classes related to risk management, or some other introduction sessions. If you all have any doubt or any questions related to this topic, I am ready to answer. Do you all have any questions? And I like to reiterate that if you all have any questions, you can unmute the microphones and ask directly, or you can send your questions and comments through the chat box. Okay. I'm thinking to give some more times. If you'll have any questions, or otherwise I will ask some questions from you. Okay, since you don't have the questions, I'll ask the questions, the simple questions to get some feedback. What is the committee responsible for liquidity risk and market risk management. In a bank and other financial institution, there's a committee which is in charge to manage the liquidity risk as well as part of the market risk. Which committee is responsible for that? Please give the name of the committee. Come on, students. We have discussed in the last class a committee which is responsible for managing liquidity risk and market risk. What is that committee? And can you give me the name of the committee just to get a feedback whether you have a good understanding about the aspects we discussed last class? Yeah, exactly. There are 3-4 answers. The ALCO is the committee which is responsible for liquidity risk management and part of the market risk. Basically, they are the people managing the balance sheet of the asset and liability of the bank, the balance sheet of the banks. Okay, so it's clear that you are sort of following my class, my theories and notes. Okay. Then the last class we have discussed about, since we are discussing about the financial risk or the managing the financial risk, financial institution risk, where the financial risk is most important. And the financial risk, as we discussed, there are 3 types of risk involving or mentioning as a financial risk. Mainly, the first one is credit risk, second one is liquidity risk, third one is market risk. And we have the last class, we have very in detailed manner, we have discussed about this credit risk, liquidity risk and market risk. And we have discussed about the mitigation mechanism for this risk. The credit, what is the mitigation, general mitigation mechanism for credit risk or liquidity and market risk? Generally, diversification of portfolio is one of the main strategy to mitigate the risk. The diversification means rather than granting NTA loans and advances to particular sector, or rather than granting NTA loans and advances to a small number of customers, the granting NTA loans and advances to the wider segments or sectors, the more sectors or wider customer base. So by diversify the portfolio, they can mitigate the credit risk, particularly concentration risk as well as default risk. Similar theory is important for a market risk also. Rather than depending on one type of investments, whether it may be government securities, it may be equity investment, it may be debenture corporate debt market, rather than concentrating in one type of market or investments, by diversify the investment, they can mitigate the risk. So diversification is one of the main strategy to mitigate the risk, in addition to some hedging mechanism or strategies. That's we have discussed in the last class. And I think this slide I skipped the last class. I'll say that okay, I'll discuss in the in next class in a detailed manner. Okay. Even though we have studied the diversification is one of the main strategy to mitigate the risk, there is other strategy which is commonly regulator expect that strategy, which is maintaining minimum amount of capital or maintaining adequate capital is one of the main strategy to minimize the risk. Okay, so for example, why the regulators are saying that we have to maintain, or the finance institution, bank and finance institution has to maintain adequate capital, because it gives additional cushion or buffer to the finance institution. If there is any unexpected loss occur, that loss will be absorbed by this adequate capital. In 2018 and 2008, sorry, 2000, not 2018, 2008 and 9 financial crisis time, some large investment banks failed or went into crisis. The main reason is they did not have adequate capital to absorb additional losses or unexpected losses. Because generally, even in the worldwide, before 2008 global financial crisis, these investment banks not come under the purview of the regulators and minimum capital requirement. Generally, the commercial banks and specialized banks are coming under the purview of the regulators, financial regulators, and they have some minimum capital requirement. But for the investment banks, there is no minimum capital requirement. So the investment banks maintain their or run their business with a very minimum capital requirements. So when there are some additional or unexpected losses hit the bank balance sheet, then the bank would not bear those losses because of their very minimum capital. So by the way, before going to that, just to get an idea, you will have an idea about the difference between the commercial bank and investment banks. You will have the idea about what is the difference between the commercial bank and investment banks, or do you have any idea about what is investment bank? Can you just tell me? Then if you will have the understanding, then I need not to explain much. Yeah, actually, there's a feedback that there's no, sir. Yeah, actually, the banking, the commercial banks or specialized banks, general banking businesses, they are just doing the conventional banking business. What is the meaning of conventional banking business? They are accepting deposit from the customers or the money surplus households, and they are granting loans and advances to the customers. Simply, the conventional banking business is accepting deposits and granting loans and advances to different customers. So they are bridging, which we have discussed in the our earlier part. But the investment banking is not that actually. They are providing sort of services, specialized services to the customers. For example, they are providing advisory services to the customers. They are providing some facilitating the institution for mergers and acquisition. And they are the investment banks providing some facilitation or some foundation to raise the fund from the institutional investors to the corporations or institution, the financial, the other corporate institution. So they are doing sort of advisory service, but these institutional banks also can invest in the securitization process also. So where then 2008 it's hit. So simply have an understanding that the licensed commercial bank get involved with the conventional banking businesses, accepting deposit and lending, but investment banking providing sort of specialized services to the financial corporates and financial institutions or the investors. So that is the main difference. Even in Sri Lanka, the investment banks are not coming under the regulators' purview generally. So that is the difference. So then our main understanding is, so there should be a minimum capital requirement for the banks and financial institutions. So that's why these people at the Basel Committee internationally, they introduce risk-based capital requirement for a company or banks. What is the understanding, or what do you mean by the risk-based capital? It means there may be different institutions, their risk level may be different. For example, we can take an example, one bank or finance institution which grant the loans and advances to only highly net worth customers, customers or AAA customers. So, and the balance part, they are just investing into the government securities. So, comparably, their risk level is very low because they are just granting to highly net worth companies or corporates as well as government securities. They don't invest, they don't go for these retail loans or SME loans or something, which can be considered, which could be considered as a highly risky customers. And other bank, they don't much mind about this highly net worth corporates and government securities. What their business model is, they are just concentrating to the SME customers or retail customers or microfinance customers, because their business model is granting loans and advances to the risky customers. Okay, let's assume both banks or finance institution portfolio is same amount, 100 million, 100 billion, same amount. Okay, is it reasonable to ask both banks to maintain a same amount of capital? Is it reasonable? I'm explaining the example again. The one bank, the bank A, which grant the loans and advances to the highly rated or highly net worth corporates. Okay, bank A granted high loans and advances to highly net worth corporates with a well diversification. We'll assume that well diversification. The bank B grant to the loans and advances to the SMEs, micro credits, and retail loans, and those kind of the risky customers. The bank B. Is it reasonable to maintain the same capital for both bank, even though the total bank size is same? It is not reasonable, because the bank B is getting comparably more risk. So that's why the Basel committee says that, okay, if whenever the bank involved with the more risky businesses, they must keep more capital, and the bank A, which involved in the less risky customers, they should maintain a comparably less capital for their businesses. Okay, this is the underlying reason. So that's why based on the some formula, they just calculated the risk weight assets. For example, in their assets, total assets, there's a formula. For example, if it is a government securities, the risk is very minimum, so the risk weight is the 0. If it is the loans and advances granted to AAA rated companies, like I think AAA rated companies in Sri Lanka, there may be, I think, SLT, Dialog, and all those kind of good companies. So what they can do is for their loans and advances, if the bank granted, they just risk weighted 50%. And if they granted loans and advances to unrated or BBB, less than BBB rated corporates, then the risk weight will be 120%. Likewise, they weight their risk, and based on the risk weighted assets, they have to maintain the capital, risk-based capital. So this is a general mechanism. Other than for a particular credit risk, a liquidity risk, and market risk, there will be sort of diversification strategy. They will, the operational unit level, they will maintain, and bank as a whole or institution as a whole, they will maintain adequate capital based on the risk of the risk factors of the particular banking business model, and based on that, they will maintain the risk capital, regulatory, more or relevant regulatory capital. So we are just calculating the capital adequacy ratio. Those who are working in the banks and finance companies may already know this capital adequacy ratio. We are based on the Basel Committee. This, as I mentioned, they just risk weight their India assets, and based on the risk weights, they have to maintain 12.5% as a regulatory capital. The capital 12.5% as a capital adequacy ratio. So the regulatory capital divided by the total base capital divided by risk weight assets and multiply by 100. It should be to a minimum 12.5%. So that is the concept about the risk weight capital, which will give an additional cushion to the banking industry or financial industry to absorb any unexpected losses. So this is giving this is a protection against the insolvency of the banking sector. Have you all understand about it? Any question you all wanted to ask? There was a question, there was a comment. I couldn't understand. Not reasonable. Is there anything you wanted to convey the message? I couldn't understand. Okay. Okay. Maybe I asked the question that whether it is reasonable to ask the same capital for both. It's not a reasonable. That's agree. That's what there are different risk weights and different capital requirement for a different banking models. So I just wanted to get sort of general knowledge. In Sri Lanka, in the worldwide, there are Basel. You may heard about the Basel document or Basel Accord, and in first Basel Accord, they say that capital risk weights. The Basel Committee introduced the capital requirement, minimum capital requirement, or regulatory capital requirement, or capital adequacy ratio based on the Basel document. And then they have introduced the Basel II document, which include some additional features to the risk weights, and based on that, they have they request some capital adequacy ratio. And currently, they have introduced Basel III. I currently means 5-6 years before, they have introduced this Basel III document. And in Sri Lanka also, we have introduced, already implemented Basel III documents. This is just for your general knowledge. If somebody asks that whether in Sri Lanka they have complied with the Basel III, yes, of course, we are following the Basel III for a banking model, banking business. So they have to maintain the Basel III. So what is the main difference in the Basel III is there should be some minimum liquidity requirement also emphasized by the particular document. That is one of the main difference in the Basel III. There may be several, but this is the liquidity coverage ratio, also one of the additional feature introduced in the Basel III. So this is about the risk-based capital. Is anybody wanted to ask any questions, or otherwise I will just move to the other sections? Okay, since there is no questions, I'll ask I'll move to the other section. Internal control in risk management. Actually, I have mentioned you all that as a first line of defense, the internal control is most important in the risk management. That is, I may say that it is the basically, for example, particularly for operational risk management, the internal control system is must. If there is any lack of internal control system, that will create a risk to the particular bank and financial institution. So with that understanding, if we see that the internal control can be defined as a system designed introduced and maintained by the bank's management and top-level executive to provide a substantial degree of assurance in achieving business objective, complying with the policies and laws, maintaining efficiency and effectiveness in regular operations. So this is sort of lengthy definition, but simply you can say that to achieve the bank objective. What is the bank objective? Maybe profit making. To achieve the bank objective, the bank in an operational level, by the top management, they will introduce some sort of controlling procedure to ensure that their objective is achieved through the day-to-day business operations. Okay, there are several internal control procedures available. The first one is segregation of duties, which everybody knows that if you go to the rather than giving an example related to the bank, I just like to give a example related to a sort of a shop or sales center where you may select an items or whatever you wanted to buy in a one section, and then if you give that section into for a billing purpose by other person, he will do the billing, and then the cashier will be in other place. So the billing has the particular receipt has to be submitted to the cashier along with the cash. So it will be the cashier will receive the cash, and then if we take that paid receipt if we submit the paid receipt to the delivery counter, they will deliver the goods. So here you can see the sales job or sales duty has been segregated into 4 components. First, selecting the items, then put the receipt, and then paying the cash, and finally deliver the goods. So when they are doing the segregation of duties, then there will be sort of more internal control system. So if one person has to do any fraud or anything, it is not possible, because it may be get caught at any places, or even an error. We need not to worry. We need not to mention always the fraud. If it is an error occur in one place, the receipt place, maybe cashier may identify, or in the delivery place they may identify. So the segregation of duties is one of the main internal control procedure introduced by the bank. Even introduced by the institutions. Here, that is, we can call that 4 Eyes principles. 4 Eyes principle mean any things can be checked by the 4 eyes. It means 2 people. Okay, so even in the bank also, if you see that any voucher or any other things, one person will be prepared, other person will be checked, another person will be approved. So there will be segregation of duty. And access control. The access control, of course, this is also one of the internal control procedures. If it is an stores, so everybody cannot enter into the stores. Only selected people can enter into the stores. Or if you will see the bank branch, the wallet, the branch wallet or bank wallet, everybody cannot access, or all the staffs cannot access into the wallet area. Only certain people can access into the wallet area. So maybe the manager, second officer, or somebody. So access control. Same access control can be observed in a in an IT room, IT server room, and all. We can observe that access control is there. That is also one of the internal control procedure. And physical verification. Physical verification, of course, I need not to mention to you all. You may know that if you have the audit experience and all, in the year end, we are just checking whether our physical stock is balancing with the books and records. So we are just checking one by one whether the physical verification is accurate. So even simple supermarket or any textile shop, any shops, you can just see this physical verification. The delivery counter, they will do the physical verification. And scandalized documentation, that is one of the documentation that is also one of the internal control procedure. And approval authority requirement, that is also approval authority requirement. Then simply we can just say that, okay, if there is any for example, if any payment be above 1 million, so there will be an additional approval authority requirement. So these type of controlling procedure could be cited as an internal control procedure. So for a risk management purpose, internal control procedure is must. And the first line of defense or the business unit managers will be responsible for implementation of internal control. Okay, just keep in mind, implementation of internal control. Sometimes it may be introduced by the top level executive. It may be introduced by the centralized risk management department. But implementation part should be carried out by the business unit or branch level. And internal audit, external audit, of course, internal audit, I have explained to you all already in the, okay, by the way, just asking a question. Internal audit coming under the which line of defense? Whether it's a first line of defense, second line or third line? The internal audit, whether it's coming under the first line of defense or second line of defense or third line of defense? Because we have discussed in the last class. Yes, it's a third line of defense. We have discussed about it's a third line of defense which give an assurance to the top management all the internal control systems are implemented properly. Here it says that it evaluates a company's internal control, including its corporate governance, accounting process, ensures the compliance with the laws and regulations, and accurate financial reporting, as well as helping to maintain operational efficiency by identifying problems and correcting lapses before they are discovered in an external audit. So these are the people just checking and giving an assurance that all the internal control policies are properly implemented. There's an accurate financial reportings are happening, and all the regulations are implemented by the business unit. So these people are giving assurance. An external audit, of course, everybody knows that it's a periodic audit conducted by the independent qualified accountants to assure whether accounting records are accurate and complete, prepare in accordance with the provisions of relevant accounting standards, and statements prepared from the accounts fairly represent the organization financial position. So external audit is sort of independent audit, qualified auditors carried out the audit and giving the independent opinion that their accounts or financial statements present fairly the organization financial position, they fairly reflected in the financial statements. So that is external audit. I think these are I just going quickly because it's nothing much explained to you. And reporting structure, if you see the reporting structure, there are three types of reporting structure. The first one is administrative reporting. What is the meaning of administrative reporting? For example, if you take the branch level, the reporting establishes a clear line of authority between the position and units in the organizational hierarchy. It is called administrative reporting. For example, if you are working in a branch, so if something happened or any or related to the business of the particular branch, the particular branch manager will report it to the regional manager or zonal manager. Then particular regional manager will report it to the AGM. AGM will report it to the DGM, branch operations. Likewise. So it's an administrative. There's a clear process, clear line of authority between this position and units. Manager, regional manager, AGM and DGM and CEO. Likewise, there's a clear procedure. Administrative reporting. But functional reporting in the sense, rather than following the administrative reporting, for certain function, they may have different reporting line. Functional reporting line may be followed by the bank and finance institution. The reporting establishes a connection between position and units, different management level, based on the specialized nature of the function for which mutual responsibility is charged. But we can just give an example. For example, a credit. Okay, so sort of very large amount of credit. One customer asks a loan facility. It's a large amount of loan facility. So in that case, it may not move through the administrative reporting. It can especially go to the this AGM credit directly, and through the AGM credit, it may pass it to the credit evaluation committee or credit risk management committee. So where the functional reporting is followed by the bank for a particular special nature of that function. So this is apart from the administrative reporting, functional reporting for a special nature they can function. For example, if a customer wanted to invest something in the treasury bills, okay, they approach a branch. So what they will do is they will just specially report it to the treasury of that bank. The bank, every bank has the treasury operations. So the mainly this treasury bill operations will be handled by this treasury, the bank treasury department. So they will just directly report it to the bank treasury. So they will offer the rate. Okay, what is the prevailing rate and all. And then and apart from the administrative reporting and functional reporting, there's a special reporting for a risk reporting, which is communication of risk management outcome for the purpose of comparing the results with the policies and early identification of potential problems. So if there is anything related to the risk, that will be the separate reporting, which is called risk reporting. For example, in every branch, there may be a risk officer. Particularly for operational risk, definitely there will be a risk officer. So if something happened in the related to risk, so it has to be reported to the risk officer. Then that risk officer will escalate that to the centralized risk management department. And then centralized risk management department will evaluate the impact of that particular risk event, and they will, based on the impact, they will escalate that to the risk oversight committee. And based on that, it may escalate to the board of directors. So this type of reporting is called the risk reporting. So with related to the risk officer, centralized risk management department, risk oversight committee, and board of directors, based on the depend on the impact and severity of the risk level. So in any bank or finance institution, there may be three types of reporting mainly. First one is administrative reporting, which is clear hierarchy, and the functional reporting. If there is any special function, there may be a special functional reporting will trigger off, and the risk reporting, whichever related to the risk management outcome, which will be reported through the risk reporting line. So there are three reporting line. That's what you want. Any question you wanted to ask? Yeah, they say that has this tune been uploaded? Yeah, there was an answer that today morning. Okay. I think that yesterday evening I have sent it. Today I got late. Yesterday evening I have sent it. So maybe they would have uploaded today morning. Okay. Any questions? Okay. Then we will move to the committees responsible for risk management. So I have already explained to you all that in the risk management, for a risk management functions, there may be different committees get involved the risk management functions. And some of the committees I have already explained to you all. And here we are going to see some more committees. I think these sections, there is nothing much to explain. This is very straightforward. The committee functions and all. I think the ALCO committee I have already explained to you all, and risk oversight committee I have already explained to you all. Likewise, some committees we have seen, but some more committees we will see in this subsequent slides. So, in order to enhance the efficiency of the decision-making process and to focus the specific area of the business, the board of directors could establish certain specialized committee. So, you'll have to keep in mind, in any business area, if it is a company, the board of directors will have ultimate responsibility and ultimate authority as well. So if there is any committee appointed in a bank, the committee level and the sort of key committees are appointed by the board of directors. They are the people who could establish the particular committee, specialized committees, and they are the people share the power to that particular committee. Okay, because in each and every function, the board of directors will have the ultimate objective, ultimate authority or responsibility. So what they can do is they can pass their duties and powers to the some committees, and through that committees they can implement that particular functions. So likewise, for the risk management purpose also, the board of directors will appoint some committees. The number and nature of the committee depend on many factors, including size of the bank, nature of the business area, and risk profile. They say that if it is a committee, it may be because there is no hard and fast rule. Sometimes some banks may have different committee for compliance function and risk management different compliance, but most of the banks in Sri Lanka, they are having risk and compliance, and the same committee will handle the risk and compliance. It's depend on the bank size and their nature of business and all. If it is more complicated and if it is the large bank, they may have different committees separately. But if it is a small bank, they may amalgamate 2-3 committees and may have one committee. One committee in the sense, a few committees. Number of committees are very less. When board appoint a committee, it should avoid a possible conflict of interest. Actually, what they have said that when the board of directors has appointed the committee, they have to clearly give the TOR, terms of reference of that particular committee, what is their function, and clear demarcation of their functions and duties, and to avoid a conflict of interest. That is one way to explain the conflict of interest. Another conflict of interest in the sense, based on the duties, some position may have the conflict of interest to carry out the business or represent the committee. I am asking a question from you all just to explain the conflict of interest. Can the chief internal auditor appointed as a chairman of credit committee? Yes or no? Can the chief internal auditor of the bank appointed as the chairman of credit committee? Can or not? Yes, that's the answer. Not. Why? Why the chief internal auditor cannot appoint as a chairman of credit committee? Yes or not? No, of course, the correct answer, because internal auditor cannot appoint as a credit committee chairman. Why?
Since they act as an independent party, which they cannot involve in day-to-day operation.
Exactly. That's the thing. And should be an independent. If an independent, because the internal auditor is considered as an independent, actually there's an answer also. Should be independent from credit function. Why it is considered as an independent from the credit function is because, okay, the chief internal auditor is the head of credit committee. If something goes wrong in the credit function of the particular bank, will he or she willing to escalate that risk to the top management? Of course, no, because there's a conflict of interest. As an internal auditor, he has to escalate that particular weakness or risk to the top management. But as a chairman of credit committee, if there are something happen in the credit risk management, he may have the hesitation to escalate that to the top management. So there will be a conflict of interest. Another answer, as that particular student mentioned, the internal auditor should be independent. He should not get involved day-to-day operation. That's why it says that when a board appoint a committee, it should avoid a possible conflict of interest. It means it should avoid appoint a chief risk officer, chief internal auditor as a credit committee, or chief risk officer as a credit committee chairman. If they appoint, that may create a conflict. So board should avoid those situations. I think you would have understand the things why I'm explaining to you all, because if there are questions, if you understand the principle of that idea, then you can answer the questions. That's what I'm trying to give the principles of that the underlining principle of that idea. Okay, then these are some of the committees for the risk management. The first one is, of course, everybody knows that board of directors. The board of directors will have the ultimate responsibility for the risk management function. They are the people approving the risk management policies, and they are the people deciding risk appetite of the risk appetite level of the particular bank and finance institute. We will discuss that later. So the first committee is board of directors. The second one is board audit subcommittee. The board audit subcommittee is the committee in charge to give assurance about the particular risk management function of a bank and financial institution. And again, there's other committee, the board risk subcommittee. Of course, in the board risk oversight committee, board risk subcommittee, there may be several names in the banks and finance institution, but this is the risk subcommittee also, one of the committee involved in the risk management function. And credit committee, of course, which will evaluate the risk emanating from the risk particular credit, the granting particular facility to the customers or the portfolio, credit portfolio. So credit committee also one of the committee responsible for risk management. ALCO, of course, we have already discussed about it, and which is in charge to manage the liquidity risk as well as part of the market risk. And investment committee, of course, we will discuss when in a bank or finance institution wanted to involve with the large investments, so that it is subject to the investment committee decision. So they also manage the risk. And IT steering committee, it is related to the IT matters. So we will see that one by one. I think need not too much explain to you all. If you need any questions, you can just stop me and ask the questions. I'll just basically I will read it, but if there is any necessary, I will explain to you. Responsibility of the board of directors in the risk management. First, decide on the risk appetite and risk tolerance level. So this is we have already discussed several times. So any in the risk management function, the first one is the bank top management should decide the risk appetite level. What is the level of risk you are ready to appetite or ready to take over? So it will be decided by the board of directors. And tolerance, of course, okay, they may decide risk appetite level is 10 million. Okay, the risk tolerance level is okay, plus 1 million or plus or minus 1 million, they can tolerate the risk level. Okay, even though 10 million, they can tolerate 1 million plus 1% or 10% as a tolerance level. So which is called risk tolerance. So it will the risk appetite and risk tolerance both will be decided by the bank. In the short term, they may go for with a tolerance level. Okay, you may ask the question. So okay, if they decide the risk appetite level 10 million and 10% can be the tolerance level, why why they wanted to again decide the two different levels, appetite level and tolerance level? They can just say that 11 million as a risk appetite level, because the tolerance level will be any unexceptional circumstances, or at a shorter term, the bank managers can go up to the tolerance level. But in the long run, they have to bring down that risk level to the risk appetite level. So that is the difference between the risk appetite and risk tolerance. For example, even in our children, so anybody, we will have sort of limit, appetite level. Okay. After appetite level also, we may have some tolerance. Okay, we will have some tolerance. Beyond that level also, we will have. Then if it is go beyond that tolerance level, then we will take some actions. Okay. But that tolerance level also should be for a shorter term. The longer run, they can't keep it always in the tolerance level. The long run level, they have to bring down within the appetite level. So that is the difference between the risk appetite and risk tolerance. So the deciding on the risk appetite and risk tolerance of the risk management level is a responsibility to the board of directors. And define the risk governance structure. What is risk governance structure? Whether it is integrated risk management or silo-based risk management, what are the framework they are going to follow, whether they are appointing the chief risk officer, whether they are going to have the chief risk officer, chief centralized risk management department, whether they are going to amalgamate the compliance function with the risk management function, or they are going to have the separate function. All the governance structure will be defined by the board of directors. And formulate the policies and procedure, which is most important. In the banking supervision, when we are going, we are saying that formulate the policies and procedures is important. Whether you may be here or you may not be here for after 1 year or 2 years, 5 years, but the policies will prevail the bank procedures. So policies and procedure, written policies and procedure must important. So the board of directors has a responsibility to formulate the policies and procedure. Create awareness on risk management. So, which is most important, because every staff, because risk management is a joint responsibility. Not only chief risk officer, not only the board of directors, not only the manager, it's even every staff, a garden cleaner, even he has to know the risk management. For example, if he doesn't lock the door properly, that may create a risk to the particular finance institution. Operation, it may be operation risk, it may be small risk, but it may create the risk. So that create the awareness on risk management in their level is important or responsible to the board of directors. encourage organization risk culture. Actually, risk has to become as a culture. So that is also they have to. And establish risk oversight function and periodically review the risk management function. Everything come under the responsibility. Whatever. If in exam, if there is any questions like that, if you can just write down these functions with a small elaborations, good enough to get marks. And responsible with the board risk subcommittee, which is, I say that the board risk subcommittee, which is responsible for review the risk management function of the particular bank. So assess the risk profile and key areas of the risk. So the risk management committee, okay, before going to that, do you have any questions on the earlier area? The board responsibilities? Okay, if you can questions, students don't have the hesitation, you can ask. Even if you feel that it's a silly question, nothing matter, ask from me. I am ready to answer, because if you have small doubts, it's clear then and there. Then it's easy for you all to study. Okay, that's why I'm always in the class. I'm always encouraging the students to ask the questions. Okay. Having that note, we will move to the next one is responsible the board risk subcommittee. So board risk subcommittee, I have already explained to you all, which is the committee established by the board of directors. So one or two board of directors may be the member of this subcommittee, and chief risk officer will be the member of that subcommittee, and there may be one or two senior management will be in the board risk subcommittee. So these people will formulate the policies, risk management policies, and they will assess the risk, review the risk management or risk related to the particular function or functions of particular bank and financial institution. So that is the committee's function. So if you see the responsibility, assess the risk profile and key risk areas of risk is the one of the main function. So actually there may be several areas the banks may have the risk. For example, the loading the cash in the standalone ATMs is one of the main area of risk. They may have handling risk, operational risk. So this committee will decide, okay, what are the policies, what are the procedures, what are the risks could arise. So they will assess the risk profile. And for example, equity investments. Okay, these days the market is okay, it's booming, stock market is booming. So we can go for an investment. But in the long run, we have to continuously assess the risk. But we don't know what will happen to the stock market, because we had some bad experience on the past. So likewise, they will assess the risk and recommend the board and adoption of the risk assessment and risk procedures. So they will assess the risk and they will recommend the board, okay, these are the risk assessment, risk procedures to be followed. So there should be some limits. And articulate the policies of oversight management of risk. Actually, the policies, articulate the policies is managing the risk is one of the responsibilities. Examine and determine the sufficiency of the internal process. So actually, even though internal audit gives the assurance, but these people has to have an examination and determine the sufficiency of the internal process. For example, if I take the early example, has handling of or has loading of standalone ATMs. So they will examine and determine whether these internal controls, existing internal controls, sufficient for that. So those type of things are responsible to board risk subcommittee. For example, these days online transactions are going on. So board risk subcommittees has to ensure that whether all online payments are safe, whether any hackers can access the database, so do some harmful thing to the bank. So they have to assess the things. Implement the risk management framework and internal control system is also responsible to the board of directors, and report the trend on risk profile, report on specific risk and status of the risk management process is one of the responsibility. Again, the responsibility of the audit committee. internal audit committee, or sorry, audit committee. Again, this is the audit committee also. One or two independent auditor may be chairman of the audit committee. One independent auditor will be chairman, and one more or some non-executive directors may be as a member of the audit committee. And these are their responsibilities. Ensure the evaluation of risk faced by the organization. Assess the internal control objectives and whether these objectives have been met. Review the risk assessment by the internal auditor as well as management. Understand key internal control issues and monitor progress on those issues. Oversees the function of chief internal auditor and internal audit department. Recommend the board on issues related to internal control and internal. Basically, these are the people, this audit committee, which assess the internal control system of the particular bank and giving recommendation to the board of directors on the internal control and internal audit functions. So this is also one of the third line of defense in the risk management function. Any questions? I don't know, I am running through. I just hope you'll understand. Again, these are very straightforward. That's why I just going somewhat quickly. If you'll have any questions, you can ask before going to starting the responsibility of credit committee. Okay, then responsibility of the credit committee. The purpose of the committee is to oversee the credit and lending strategies objective, advise the board on policies related to credit management. Actually, the credit committee is sort of a centralized committee. This is also we can call as a part of the second line of defense. If a branch level, when they are getting the credit request, if the limit is above the certain the request is above certain limit, then it has to go to the credit committee. So credit committee, they may centralizedly process the credit, the requirement and all. They will approve whether we can grant the loan, branch can grant the loans to particular customer or not. Oh, they are the people responsible for implementing some policies related to the credit risk management. And they will give an advice to the board on the credit risk management. Okay, they may say that now the tourism is very risky, so don't grant any additional loan to the tourism sector. So related to credit risk management, they will give some advice. And oversee the credit risk management, including review the internal credit policies and establish portfolio limits. They will give. Review the quality and performance of the credit portfolio is also one of the responsibility of the things, because okay, there may be policies and procedure. This is one of the other things we observe in the banks. Bank may have the nice policies and all, but it has to be reviewed. Time to time it has to be reviewed. Otherwise, no point. So it has to be reviewed, and quality and performance of credit policies has to be reviewed, as well as credit portfolio also. Okay, once they granted, they have to see whether this portfolio is of quality, and if there is any concentration risk, or if there is any unforeseen risk are involved with this credit portfolio, they have to review the quality and performance of the credit portfolio. And regulatory report on the senior management, regular report to the senior management board on the issues related to credit risk management is the responsibility of credit committee. And IT steering committee, of course, which committee is related to handle the IT related matters. Especially these committees are important the pandemic time, because pandemic time bank is mostly dependent on IT. Even every customer prefer to transact with the IT through the online transaction. So IT is much more important, and the risk related to IT also much more important. So the IT committee is related to those matter. So these are the things you can just, I think, read it and get it. The formulate the IT policy for the organization, review its frequent interval, ensure the IT strategy, and advise the board on IT related matter. Because definitely IT related matter, IT committee has to advise to the board, because not necessary every member has the adequate knowledge on the IT matters. So it is important to give an advice. So that is all about the committees. Any questions? I think we have some more slides to complete this. If you have any question, you can ask. Okay, then there is other officer called Chief Risk Officer. The Chief Risk Officer is also most important person in the risk management. I have already said that if it is an integrated risk management function framework prevail in a particular bank, there will be a centralized risk management department, and the bank will appoint an officer called Chief Risk Officer. He is also mainly coordinate the risk management function of a particular bank. In general, Chief Risk Officer is the head of the integrated risk management department, and he is appointed by the board or risk subcommittee. The Chief Risk Officer is responsible for oversight function of the organization. So risk oversight function is he is responsible. CRO should not have responsibility to any operational business line or revenue generation function. Why? There's a question in the exam, I'm just asking. It says that CRO, Chief Risk Officer, should not have responsibilities to any operational business line. Are you agree with this statement? Please explain. Are you agree with this statement or not? The Chief Risk Officer should not have responsibilities to any operational business lines. Are you agree with that? If you agree, what is the reason? Are you agree with that? Chief Risk Officer should not involve with any business line of the bank? Yes or no? Agree. Yes, agree. Why? Simple answer. Why he should not get involved with the, any business line? Yes, he should be independent. Basically, we can say that there should not be conflict of interest. If he is involved with any line, a business line, business reporting line, then there will not be any operational business line, then there will not be any. So there will be, if the Chief Risk Officer involved with the operational business line, then there will be a conflict of interest. The same as like I explained to you all about the internal audit. For example, if a Chief Risk Officer involved with the credit function, and if something goes wrong in the credit function's risk management, then since he is the in charge for those both things, he may have the hesitation to escalate those risks to the top management. So there will be a conflict of interest. So that's what it says, that Chief Risk Officer should not have responsibilities to any operational business lines or revenue generation functions. CRO should be independent of business reporting line and maintaining independent risk reporting. That is important. Even though risk officer does not have the independency as like an internal auditor has, but he also, the Chief Risk Officer also has certain level of independence, should have certain level of independence. He must have independent reporting line, where generally Chief Risk Officer directly reported to the risk subcommittee, and risk subcommittee will escalate that to the board of directors. CRO directly report to the board risk subcommittee. Okay, CRO to have access to information necessary to perform his duty. So CRO must have all the information should be provided by the branch level to the CRO, Chief Risk Officer. It means the risk department. And Chief Internal Auditor, of course, you all know that the person who is in charge for the internal audit department, the Chief Internal Auditor is responsible for audit operation and process as per the mandate given by the board to ensure that the business operations are conducted smoothly. Chief Risk Officer, Auditor, Chief Internal Auditor should not get involved in the business decision-making process because to avoid the conflict of interest. CAA should be independent of business reporting line, and CAA directly reported to the board audit subcommittee as per the audit charter. So this is also similar to the CRO function. So say similar principles are applicable for the CAA also. Okay, this is all about risk management function. Now, if you are clear with these theories and concept, especially underlying principles, then you can earn at least 22 marks in the exam, maximum 44 marks. Because some years there may be 2 questions. Some year definitely there will be 1 question. At least 1 question. Okay, so initially we have discussed about what is risk. We start with what is risk, and then we have started with what is risk, and then we have started risk management process, and then we have discussed about the risk classification, financial risk and non-financial risk, and then we have discussed about the 4 causes and 3 losses for the operational risk. And then we have last class we have discussed about the different risk management framework, and under silo based and this integrated and different risk line of 3 lines of defense. And then we have discussed about this financial risk in a detailed manner, credit risk, market risk, liquidity risk. And today we have covered some other areas, committees and responsibility of the officers and all sort of things we have discussed. So this is all about the risk management function. So as I told initially, I will discuss 1 or 2 papers related to risk management function to get a clear idea. Okay, do you have any questions? Students, if you don't have the questions, there may be 2 options. There may be, I can get 2 assumptions. The first assumption, if the students got everything clear, there may not be any questions. Or if a student does not get anything, then only even that situation there won't be any questions. But I assume that you will understand fully. Okay, that's why you have not asked any questions. Okay, if you all don't have the questions, we will move to the past paper question and answer. Before moving to that, I have some other administrative things to share with you all. Yesterday, I received a mail from IBSL, the Institute of Bankers Association, these bankers of Sri Lanka, IBSL, saying that they are expected to have the exam at the latter part of October. Okay, last week of October. So, in order to you all to sit the exam in comfortable manner, they wanted us to complete the these sessions, all the syllabus before 16 October. and they will have the exam in the latter part, October, maybe 23rd or something. So they wanted so, but earlier initially we have planned this lecture series till 6 November. So we have to complete this lecture series before 16 October. It means the 5 classes, we don't have the time to complete the 5 classes. So in order to adjust that, so we have the IBSL wanted us to have some additional classes at your convenient time. Okay, so what they are asking is conduct the classes the weekdays evening 7 to 9. Evening 7 to 9. I just wanted to get your opinion whether you all are convenient for that. And if it is so, what would be the convenient time? Which day? Of course, the Wednesday is I'm just occupying because generally our monetary board meetings are coming on Wednesdays. So if it is a board meeting, of course, it may take 8-9 o'clock to return to the home. So it is not feasible for the Wednesdays. But other 4 days I am free. So you can choose, you can select one weekday, and if you're giving me, then I can inform to the IBSL people, and then they will make arrangement so I can take the class, conduct the class during that. Can I know your opinion whether you'll prefer to have that special classes first? If it is so, what time and which days you are convenient? Students, because other lectures are like just try to announce, but I like to get your views also, because you are the ultimately you are the people has to learn, and first your willingness is important. Can you give your opinion? You can unmute the microphone and tell me. Thursdays or Tuesday? There's options given. Thursday or Tuesday, 7 to 9 evening, 7 p.m. to 9 p.m. Which day is preferable? Shall we have on Tuesday? Is it okay? Okay, there was other thing, any day without Thursday. Then shall we fix on Tuesday? Are you agree? Okay. 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 There are positive feedbacks. So from next Tuesday onwards, Tuesdays 7 to 9. Okay. So most probably I will start compliance function or corporate governance. So one of the topic I will start on Tuesday. So we can just move that. Can't we just adjust the time? Can't we just the time? I'll prefer. Sir, can we please readjust the time? What time? 7:30 to 9:30. Okay, I am okay. I'm okay. Maybe you all may return from work. Is everybody okay for 7:30 to 9:30 Tuesday? Fine. Thank you. So everybody, just 7:30 to 9:30 Tuesday. So coming Tuesday, I'll just inform to the Kavindra. So I'll inform to the Kavindra, and Kavindra will send it to you link or something, and I'll try to give my tunes or presentation by Monday evening, so you may get it Tuesday morning or Monday evening. Okay, so that is the arrangement. So from next Tuesday onwards, the 5 classes I will take continuously 5 Tuesdays. Okay, that's okay. Thank you so much for your cooperation, and that's a great appreciable. Okay. Then we will move to the past paper question and answers. This is just to give an idea, because it's better, because once we, as I'm always mentioning you all, that there are two purposes for studies. The first one is increasing our knowledge or gaining some new knowledge, even though that is the first option. The second objective is also most important, which is pass the exam, because that is the ultimate objective. So for that objective, I just thinking that I thought that it's better to see some past paper questions. So this is the question paper 2019 September. Okay, which is related to the risk management, and particularly about the liquidity risk management. Okay. Okay. The fundamental role of deposit-taking financial institutions is the maturity transformation of short-term deposit into long-term loans, which make deposit-taking financial institution inherently vulnerable to liquidity risk. Deposit-taking financial institutions are responsible for sound liquidity risk management. Okay, before going to the these other questions, first we will just understand about that first statement, because if you see the question, generally they give some statements and then only they are giving some other factors to questions related to that. So first, you will agree that whether these the fundamental role of the business taking financial institution, deposit taking financial institution is maturity transformation of short-term deposit into long-term loans. Are you all agree with this statement or not first? Yes, of course. They are generally, as I explained to you all, that they are taking very short-term deposit, maybe less than 1 year. Most of the deposits are less than 1 year deposit. But they are granting loans and advances to 3 years, 5 years, 7 years, and if it is a home loan, 15 years and all. So definitely there will be a mismatch between the deposits and loans. Simply say that assets and liability. So which create a bank, they are inherently vulnerable to liquidity risk. Okay, because they are granting loans and advances, because the depositor may come and ask within 1 year their deposits, but the loans and those who got the loans, they will repay in 5 years period. So the bank has to manage this difference, so that may create a liquidity risk. The first question is, deposit-taking financial institutions are responsible for sound liquidity risk management. Do you agree? Briefly explain the answer. Agree or not? Agree. Because they have to have sound liquidity risk management. And the main funding source of the liquidity risk management is deposits. So deposit involve financing intermediary function and fund receive, as I explained to you. Then if you all write it, that which I have explained to you all, that this is they are getting the short-term funding, but they are granting the long-term, and so there will be a gap analysis, gap between the assets and liability, which created the liquidity risk to the bank. Okay. Then ALCO, the second question is ALCO. The Asset and Liability Committee play an eminent role in managing the liquidity risk and market risk exposure of the deposit-taking financial institution. Briefly discuss, which we have already discussed. I think I need not to explain to you. Or do you all wanted to even in the past paper question and answer, it's there, and we have discussed already. You all wanted me to explain to you, or we have already discussed since? Is anybody wanted? Because since we have discussed in the class, I feel I need not to okay, I just because since I even though I have discussed with you all, I just mentioning you all. If you all wanted, just getting note down. This ALCO is a decision-making committee to manage the assets and liability of the banks. So, which manage the liquidity risk as well as market risk of the particular bank, particularly the interest rate risk of the banking book. So they are just managing it, and which has certain responsibility. The first one is to ensure the efficient implementation of balance sheet management policies and to receive and review the reports of liquidity and market risk management, to identify the balance sheet management issues that are leading to underperformance, and review the deposit and loan product pricing strategy, which everything I think we have already discussed. So just mention those things, good enough to get the marks. Why do you believe that public confidence in deposit taking finance institution is important? Briefly explain. Okay, this is some questions which we have discussed, even though we have discussed, but not exclusively. Can someone answer for this? Why do you think that? Why do you believe that public confidence in deposit taking financial is important? Briefly explain. Can someone answer? Why public confidence is important for deposit taking finance institution? Come on, students. Why public? And actually, we have discussed these things, and I know the example also. Yeah, there's an ad to have faith in the depositing funds, of course, because I have explained to you all that the banking business, not like other business, the banking business mainly run with the depositors' money. So the depositors are depositing the money because of the confidence that this bank will be there, will be function for their period, for a long period. That confidence should be there among the depositors. Then only depositors will come and deposit with the bank. I believe that I gave an example that if you go and buy the some milk powder from a supermarket, there won't be any much going concern concept or anything or confident. Actually, I'm paying the money and they are giving the milk powder. Milk powder is okay. Finish it off our relationship. But if it is a bank, I'm investing for 1 year deposit. I'm deposit for 1 year. I must have to think about whether this bank has to run for 1 year. After 1 year, when I am coming and asking the money, they have to pay the money. So the depositor's expectation may be higher than the customer expectation in the supermarket. So that confidence should be there. So if something happened to that confidence, then that will lead to a bank run or deposit run situation. The deposit run means the most of the customers rush into the bank to get more money from the particular bank simultaneously. That will be affect the going concern of the banking business. So these are the things you have to mention. So the public confidence is important for a deposit taking finance institution than other businesses. Okay. What are the main factors contributed to Lehman Brothers Incorporation to fail? Three listed corporate relations. Actually, there's other topic. This is we will discuss in other topic about some Ponzi schemes and this failure of global financial failures, crisis. So in that case, we can cover in detailed manner. Just to complete this question, I just telling you, in 2008 and 9 financial crisis, the Lehman Brothers is a very largest bank in US which collapsed due to the global financial crisis. After this, the global financial crisis got severely affected the global after this Lehman Brothers failure. So why the Lehman Brothers failures? As I mentioned, they don't have the adequate capital and irresponsible lending patterns, and they leverage highly leverage their business or the capitals, and they highly leverage means they just borrowed a lot of things, highly borrowed against their capital. So those type of things, and there is no any weaker policies in the lending procedures and all factors. Just for time being, keep it. These are the things, but we will learn this Lehman Brothers things separately in one other topic called financial institution fraud or something, where we can just learn it. Okay. Anything you all wanted to ask? Otherwise, I'll just move to the other questions. Actually, one of the students gave a good answer there, because the bank run no public fund if confidence can lead to a bank run. That is the answer for that question 3. Okay, 2019 March question, which is also relevant to the liquidity risk of the bank. First, we will just read out the statement. Liquidity is the ability of the deposit-taking financial institution to meet obligations as they come due without incurring any unexpected losses. The maturity transformation, why they are saying that it's without incurring any unexpected losses? It means the liquidity is the ability of deposit-taking finance institution to meet their obligations as they come due without incurring any unexpected losses. Why they are so? Because, for example, I have already explained to you all that if it is a 30 years bond or 20 years bond, but they could not sell that bond into the reasonable price and make it as a cash, then there will be the company or bank or the particular finance institution compelled to go for a fire sale. At that time, there may be losses to the bank. So that's why they are saying without incurring any unexpected loss, whichever the liquidity should be able to make it as to meet the obligation. The maturity transformation, which is fundamental role of deposit-taking financial institution, involved in the transforming short-term deposit into long-term loans. The process thrives deposit-taking financial institution inherently vulnerable to liquidity risk. So if you see that the same questions are coming again and again. So if you're thorough with the question paper or past paper questions, you may pass the exam. So that's what I just go through the question papers. Question paper, that's also important. So first question is, liquidity risk management is paramount important as any liquidity shortfall of the deposit-taking financial institution can bring whole system-wide repercussions. Do you agree? Explain your answer precisely. What is that? Liquidity risk management is paramount important as any liquidity shortfall of any deposit-taking financial institution can bring whole system-wide repercussions. Do you agree? Explain your answer precisely. First of all, tell me, are you agree with this statement or not? Because when there is any questions like that, you'll have to first say that whether you agree or not. For that, actually, 1 marks is allocated for that. Sometimes the students write the questions without saying agree or not, but the answer is right. They will lose the 1 marks because they don't say whether it's agree or not. So you have to say whether you will agree or not. Yeah, there are correct answers. Agree. That's okay. I am also agree with that. Why? Do you agree? Explain. Here we have to notice this question. This is something different. They say that if there is any liquidity shortfall of any financial institution, that can bring all system-wide repercussions. Why they are saying is the liquidity risk may create contagion effect to the financial system. It means if a bank or finance companies, or a bank, particularly bank, if one bank does not meet the obligations, then the customers will lose the confidence on the particular bank. And that may create then the people will lose the confidence on the particular bank, and that may create an effect to that may create an adverse impact on the confidence on other financial institution also. Then all the customers will rush into all the banks and ask the money. That is one way. Another thing is, all the banks are interconnected each other. Okay, because for example, if a bank may have the placement, for example, for example, People's Bank may have the placement with the HNB. HNB may have the placement with the commercial may have the placement with the People's Bank. Likewise, they are maybe interconnected. If they are in this chain, if there is any interruption in one place, that may create an entire system-wide risk repercussion because if one person has to stop that one chain, that may create a systemic risk also. So you will have to say that agree, because it's a confidential issue. If one institution unable to pay the deposit, that may lose the confidence on the particular institution, and it may create a contagion effect to the other banks as well. That is one thing. And second thing is, the banks may have highly interconnected through the placement, borrowings and deposits or placements. So if that chain is dropping somewhere, that will create a risk to the other institution as well. Okay. The second one is, what does it mean by bank run? How does a deposit insurance schemes could mitigate the effect of a bank run? Okay, what is the meaning of bank run? Can someone unmute the microphone and tell that what's a bank run? I think just now I explained to you.
Due to adverse information about the bank, people they used to go bank and they withdraw the money.
Yeah, that's a thing. We'll have to mention two words, the mainly. Most of the customers rushing to the bank and demand their deposits or withdraw their deposit simultaneously. There are two things you'll have to mention. The most of the customers simultaneously, these two words. The most of the customers approach the bank and withdraw their money simultaneously from the bank is called bank run. Okay, because due to the negative, it may be mostly created through the negative information about particular bank. I think 10 years before we had a situation in I think 10 to 15 years before, we had a situation in a private bank, one of the large private bank, which had sort of bank run. That time I was a very junior officer in the central bank. So I was in charge for that bank also, to handle that bank. So it's a bank run started. Then what we have done is we visited to every branch and see whether there were a lot of queue, what's happening there. Then what central bank is lender of last resort. Central bank started to pump the money. So once they started to pump the money, then everybody rush into that bank, but bank is ready to give all the withdrawals. And then first day it was a huge withdrawal, and second day then there was a small, and the larger than the first day. Then but after 1 week and all, it started to settle down, because people got the confidence that whatever money they ask, the bank is ready to settle. Then the confidence could build up. So the bank, so that is I just given some other idea. But for this question, you have to run the simultaneous. Most of the customers withdraw the money simultaneously from a bank is called bank run due to the negative information. Okay. What is the insurance scheme could mitigate the effect of bank run? The deposit insurance scheme, what is the limit now? Current limit of the deposit insurance?
600,000?
No.
1 million?
1.1 million.
1.1 million. That is exactly 1.1 million. Very recently, actually, 600,000 is the right answer. Was the right answer, but now we have increased to 1.1 million rupees. So actually, the deposit insurance scheme, which if a bank fail, that small depositors can get the compensation up to 1.1 million per customer per bank. Okay, you have to say there's a other thing, per customer per institution. So if a member institution, it may be bank or finance company, fail, the per customer per institution, they can withdraw 1.1 million. Okay. So if when a customer have a deposit less than that 1.1 million limit, customer will not rush into the bank to withdraw their money, because customer know that, okay, if something happened to the particular bank, I can get the money from the deposit insurance. So within 6 month period. So the deposit insurance scheme will mitigate the effect of bank run, because it will give an additional confidence to the small depositors, saying that confident to the small depositors, mentioning that if something happened to the bank, then they may get the money from the deposit insurance. That is the idea. That is the way it mitigates the effect of the bank. Understand? So actually, the bank deposit insurance is a way to give a sort of cushion to the small depositors. Okay. Briefly explain the importance of asset and liability committee in a deposit-taking finance institutions, highlighting at least 3 main functions, which is we have already discussed in the last September paper. So this is the way. I'm just wanted to reiterate that again and again, coming the same question. So just you'll have to mention. You'll have to, if you go through, it's easy to just answer. It's the same thing. Same answer. Briefly discuss the importance of contingency funding plan in liquidity risk management. What is the meaning of contingency funding plan? I have explained to you in the class. One of the liquidity risk mitigation, under the liquidity risk mitigations, I have explained to you all the contingency funding plan. What is it?
Making arrangement with another bank in case if one bank runs out of fund. So
Exactly. That's the answer. That's the answer. Thing is, if the contingency funding plan, or the most of the every bank should have the contingency funding plan, planning arrangement with other financial institution or with other bank, with the condition that if there is any urgent funding requirement, that bank will give this the particular funding with a certain limit. Okay, so that is called contingency funding plan. And this contingency funding plan is important to meet or to mitigate the liquidity risk of a particular bank. Okay, that is all about the contingency funding plan. If you have the understanding, I can say that, for example, Union Bank. Okay, I'm just getting the real example, but the hypothetical example, but the real names, so you can have the understanding. Just get it. It's a hypothetical example. So Union Bank, which will have a agreement with the Sambat Bank. Okay, if there is any contingent funding plan, if there is any urgent, so you will have to give up to 5 billion as a liquidity. Okay, so but that they won't use it. It is a funding plan, contingency funding plan. So for that, they may have to pay some 2% or 3% as a commission to the Sambat Bank. But if any urgency, Union Bank wanted to have that funding, 500 million or 1 billion, then they can approach this commercial bank based on the terms and conditions. Sambat Bank, based on the terms and conditions, Sambat Bank will release the fund to the Union Bank. So then they can easily manage, because if there is any market inefficiency, the contingency funding plan will help the bank to sort it out the liquidity risk. So that's about the contingency funding plan. I hope you will have understand it. The risk management, this is again, if you have observed that 2019 March, there are 2 questions. So that this is for you can just earn the 40 marks from the risk management. Okay, the risk management enable the deposit taking finance institution to bring their risk level to manageable level while not severely affecting their income. Therefore, risk management encourages such institution to take required level of exposure in order to meet the profitability target. Discuss the importance of independent risk management function for a deposit-taking finance institution. What is the independent risk management function? Under the integrated risk management framework, there will be an independent centralized risk management department to oversee the risk management function of particular bank and financial institutions, which is important to manage the risk without any conflict of interest, and time to time escalate the risk to the important risk to the top management. Okay, so you have to answer the questions with the way about the connected to the second line of defense. Okay, so you'll have to first say that under the integrated risk management framework, as a second line of defense, there will be the centralized risk management function. The centralized risk management function will be in charge for overseeing the risk management function of the particular bank and finance institution, and that particular banks and finance institution risk management function should be independent and avoiding any possible conflict of interest in the function. And then if there is any risk, that will be escalated through the centralized risk management department to the risk oversight committee. Likewise, you have to discuss about the independent risk management function of a depositing. What are the key activities of the risk management function? What are the key activities of the risk management function? This is, I will not give a answer. Actually, you'll have to give the answer. What are the key functions of risk management function in an institution? There are 4. I can just give the clue. Somebody, okay, IBSL online, they asked that examination closing date is 15th August 2021. So if there anybody wanted, they can apply. Okay, what is the risk management functions? There are 4. Come on, students. The first class I have explained to you all. Are you online? There are 4 functions in the risk management. Come on, students, you'll have to go through this. Then and there, it's easy. There are risk management functions. There are 4. Identify the risk, assess the risk, mitigate the risk or control the risk, and monitor the risk. These 4 activities are the key activities of risk management functions. And I just I gave to you all very brief note on what is identifying the risk, assessing the risk, control the risk, and mitigate the risk. If you write it those things in very briefly, that's all about this. The answer for the second questions. Understand? Am I audible?
Yes, sir.
Yes.
Okay. Then third one, maybe you are tired, and maybe normally I stop the class, but I just wanted to finish this because it's good for you all. That's what I just go through. Okay, I'm running through. The maturity mismatch in asset and liability in the deposit-taking financial institution make it vulnerable to liquidity risk. Do you agree with the statement? Briefly explain. This is agree or not? Agree. Because maturity mismatch will be we have discussed about it, and this is related to the 2018 question. So if you give the same answer, maturity mismatch answer, that would be the answer for this also. Why do you think that board of directors of a deposit-taking finance institution should bear the ultimate responsibility in understanding the risk assumed by the finance institution and implement appropriate mechanism to mitigate such risk? Explain your answer. Why do you think that because the board of directors has the ultimate responsibility to run any to have any activity of a particular bank and finance institution, and they are the people deciding the risk appetite and risk tolerance level of the banks and institution, as well as they are the people formulating the policies in the top level and creating the culture, the risk management awareness culture. So they are the people has to take the ultimate responsibility to on the risk mechanism, appropriate mechanism to mitigate such risk. So you'll have to write this, the board of directors connected to the board of directors responsibilities, and give the answer. So basically, they say that they are the people set the policies, oversee the risk management and governance, and actively manage the information flow and as well. Okay, that's about the answer for question 4. If you all wanted, actually, they are the people appoint the chief risk officers and all. So I don't know whether you all are ready with the papers. So students, keep in mind, even in the few other sections also. So I will cover the first 2 and 2.5 classes, this theory, and then last class and latter part, I will discuss about the papers. So better just ready with the papers. If you please collect the papers and ready, then they are ready with the questions of related topic. Okay, that's all about today's class. If you have any questions, I can. Okay, here there's a question. 1 minute. Okay, IBSR online, when the recorrection results will be out? Of course, I don't know that. You'll have to ask from Kavindra. I can just check with the Kavindra and let you know the next class, next Tuesday. That's I can. I'll let you know next Tuesday. That is one thing. Another thing is, somebody asked that. Okay, somebody said that recorrection results are out. So I think it's already out. Just check. And they say that, sir, for a foreign currency deposit, they are getting 1.1 million or lesser than, and that for deposit insurance due to the foreign currency rate. No, it is very clearly saying in the Gazette notification. In 2010 September, they have published the Gazette notification. Even if it is the rupee deposit or foreign currency deposits, the depositors are eligible to get the same amount. So they are, even if it is a foreign currency deposit, they are getting eligible to get the 1.1 million deposits. That is, there is equal to 1.1 million foreign currency. But they may release, I don't know practically, but my opinion is they may release in the rupee term, because even they have the foreign currency deposit or anything, whenever they are releasing to the domestic, in Sri Lanka, they will release as a rupee term. So in that case, they may release they will give the compensation in the rupee term, but even in the foreign currency deposits are subject to the deposit insurance. So you need not to worry about that. I think you need not to worry about, in the sense they also subject to the deposit insurance. Actually, this deposit insurance, I just observed that most of the people doesn't know much idea about that. So it is the bankers students, your duty to just take it these ideas to the students. Okay, time is close to 12:30, so I am stopping the class with that. And we will start one new topic in coming Tuesday, 7:30. I will agree. Okay. Thank you so much.